Essprom. EPM Simplified. Close Management and Consolidation. Benefits of using CMC. Close management consolidation of a company and its subsidiaries. Welcome to the world of CMC. This is the home page, and this is how the application looks like the first time you log into CMC. Let's now walk through each section one by one. First, we'll cover the entity and ownership structure, and how you can control and manage it. To access this, click on Application, then go to Consolidation. Ownership management involves managing global consolidation settings and applying these settings to each entity hierarchy on a scenario-by-scenario, year-by-year, and period-by-period basis. It enables you to model the financial impact of changes to your ownership structure, such as acquiring or divesting a company. This information can be used to make informed decisions about potential transactions. Here, you'll see that the application displays the group entity representing global entity. New York, which is a 100% holding company under Global Group. New York has acquired 70% in Chicago, making it a subsidiary. New York has acquired 30% in Surabaya, making it equity. As we mentioned, the ownership percentage of New York is 70%, and its consolidation method is marked as subsidiary. Since it owns 70% of the entity, the system automatically calculates the minority interest as 30%. This calculation is handled automatically by the application. Now, if you wish to modify the ownership percentage, you can do that using this form. It's a simple and user-friendly interface where you can easily change the ownership, whether it's adjusting 80% to 70% or 60% for a subsidiary, or even setting 30% as equity for Surabaya. It's fully editable. The next key feature in the CMC application is the flexibility to load data from your source instance. In a typical client setup, the source data can come in many formats. It could be from NetSuite ERP, Oracle EBS, or even a simple text file. Regardless of the source format, CMC provides the capability to transform that data into a format readable by the application. This transformation process is usually a one-time implementation, meaning users don't have to manually transform or reprocess the source file each time. It removes that operational headache. Let's take an example to demonstrate this. Here, you can see a sample trial balance file provided by the customer, which contains multiple records. Using the NetSuite CMC tool, we can transform this raw data into a more readable and structured format, one that's presentation ready and can be seamlessly loaded into the application. The tool we use for this transformation is called Data Exchange. Now, I'll switch over to Data Exchange. As shown here, this is the integration setup screen. You can see the name of the integration and the section where you map your dimensions from the source file. You can also map your members here. It's a very flexible tool, allowing you to map the source data to a clean, structured format that the CMC application can process. This tool can handle any data format and convert it for use in CMC. Once the data is loaded, it will appear on your screen with a confirmation that the data has been successfully imported. During the import, the system validates the data and completes the export to CMC. After loading is complete, we can now take a look at how the data appears within the application. Once data is loaded and consolidation is run, it gets automatically allocated to different movements based on the account mappings and attribute configurations defined in the system. Allocations are driven by the rules and metadata assigned to each account, and this actually helps in defining the cash flow, which we will cover in later part. Let's now explore how the ICP configuration is set up. To perform this, navigate to the CMC environment, click on the navigator, click on Configuration under Application, click on Enable Features, and then, under intercompany data, you can see that they are enabled. This must be done once during the application creation process. Next, select the account member and add the ICP attribute, click on Save, and then run DB refresh. Let's start by navigating to the income statement data, which has been loaded as part of this process. As you can see here, a portion of the trial balance corresponds to income statement data. It shows how the income statement has been populated in the application. Within the income statement hierarchy, you can view various key accounts such as sales, gross profit, operating income, owner's income, or similarly. In our example, we're looking at New York, which is a holding company and is 100% consolidated. The form begins with the entity total, entity currency view. Here, you can see New York's balances in its base currency, equity of $100,000, made up entirely of common stock, along with retained earnings, 0 in this case. Next, the same balances appear in the Entity Total, Parent Currency tab. Since both the holding company and parent use USD, there's no translation difference here, but if currencies were different, this is where you'd see the translated numbers. From there, the data moves to the proportion stage. At this stage, the system reflects New York's balances in full because this is a 100% consolidation, meaning the parent owns the entire entity. Unlike a partially owned subsidiary, there is no minority interest calculation here, since there are no outside shareholders. Also, we can see that at the elimination, the New York intercompany receivables of $25,000 have been eliminated. Finally, in the contribution total view, you see the clean picture. 100% of New York's equity is carried forward into the consolidated equity. There is no minority interest line since this is full ownership. In our example, we're looking at Chicago, a subsidiary that is 70% owned by New York. The form begins with the entity total, entity currency view. Here, you can see Chicago's balances in its base currency, equity of $200,000, made up of retained earnings and common stock, along with net income of $120,000. Next, the same balances appear in the Entity Total, Parent Currency tab. Since both entities use USD, there's no translation difference here, but if currencies were different, this is where you'd see the translated numbers. From there, the data moves to the proportion stage. At this stage, the system reflects Chicago's balances in full, before any eliminations are applied. Now comes the elimination step, and this is where minority interest comes into play. Here, the system automatically removes Chicago's equity balances, since subsidiary stock and retained earnings don't appear in the parent's consolidated equity. At the same time, it calculates the 30% that belongs to minority shareholders. To illustrate, 30% of net income equals $36,000, which is the minority interest. Finally, in the contribution total view, you see the clean picture. The parent's 70% share is carried forward into consolidated equity. The 30% minority interest is shown separately, ensuring full transparency. Step by step, you can see exactly how the system takes entity-level data, applies ownership logic, runs eliminations, and produces the consolidated view, all with clear visibility at every stage. In our example, we are looking at Surabaya, which is consolidated using the equity method. We begin with the entity total, entity currency view. Here, Surabaya's balances are shown in its local currency, retained earnings current, pre-ownership change is missing, and common stock is 100,000. Next, the same balances appear in the entity total, parent currency view. Since Surabaya's currency is the same as the parent's, the system copies the same value into the parent's currency. The data then moves to the proportion stage, where 0% proportion is applied. This is because Surabaya is an equity method entity, its line-by-line balances are not rolled up. Instead, only the parent's 30% ownership share of Surabaya's net income and equity adjustments is taken into account. In the elimination step, adjustments are recorded. For example, retained earnings current plus other reserves plus CTA equals 200,000. Applying 30% ownership, the parent's share is calculated. The system records, FCCS_equity company income equals 60,000, FCCS_investment in equity companies, income equals 60,000. On the balance sheet side, FCCS_investment in equity companies, investment equals 30,000 is updated. Finally, in the contribution total view, the parent's share, 30% of 200,000 is equal to 60,000, is shown as a single line adjustment. The investment is updated to 30,000, and income is recorded as 60,000, giving a clear and accurate consolidated view. Let's walk through the complete roll-up process step by step. At the top, we have the global group, which is the final consolidation point. But first, let's look at the USA roll-up. Within the USA, there are two entities, New York, the 100% holding company, and Chicago, a 70% owned subsidiary, where we run consolidation, and CMC calculates results for both New York and Chicago individually. For Chicago, the system automatically applies the 70% ownership, calculates the 30% minority interest, and eliminates intercompany transactions. For New York, it consolidates all of its balances as is. Once that is done, both Chicago and New York roll up directly to the USA. This gives us the final USA numbers, complete, clean, and free of duplication. Now, for the rest of world roll-up, we have Surabaya, which is a 30% equity investment. CMC applies the equity method, taking only New York's proportional share of Surabaya's equity and net income, and rolls that into the rest of world total. Finally, we have the global group roll-up. At this level, CMC combines the results from the USA and the rest of the world to give one single, consolidated financial picture at the global level. The USA Group entity reports in USD, while the parent company reports in IDR. During consolidation, all balances from the USA entity are translated from USD into IDR. As exchange rates fluctuate over time, translation differences arise. These are not actual gains or losses from transactions, but rather unrealized translation differences. In CMC, such differences are automatically captured in the account called Unrealized Gains and Losses on Translation, also known as the CTA account. This process ensures that the consolidated financial statements remain accurate, consistent, and fully balanced at the parent level. Let's navigate through one more step, which is intercompany reports. Intercompany reports help you ensure that these entity and partner intercompany transactions are matched correctly. In this intercompany reports, we can clearly see how the different intercompany transactions are matched and how the different plug accounts are getting calculated. For more details, mail us at support@essprom.com.